Dr. Jian Yang.
Mr. Speaker, my question is to the Minister of Finance. What reports has received on outlook for the economy?
Honourable Stephen Joyce.
Mr. Speaker, on behalf of the Minister of Finance, the Reserve Bank today issued its latest monetary policy statement for March. It kept the official cash rate unchanged at 2.5%. The Reserve Bank also slightly revised up its outlook for the economy from its projections in the December monetary policy statement. However, it did note the recovery remains somewhat uneven, with demand and output expanding and consumer confidence increasing. On the other hand, it noted a continued drought would have a negative impact on economic output. Overall, the central bank now expects annual average real GDP growth to rise from just over 2% in the year to March this year to around 3% in 2014 and 2015, before easing back a little in 2016.
Supplementary question, Dr. Yang.
Supplementary. What are some of the factors driving the Reserve Bank's forecasts for growth over the next few years?
Honourable Stephen Joyce.
On behalf of the Minister of Finance, the Reserve Bank notes that reconstruction in Canterbury is picking up and will be a key driver of economic activity over the forecast period. Residential investment in other parts of New Zealand is also expected to increase as a result of mortgage interest rates remaining low. The Reserve Bank also expects export growth to be slightly stronger in the latter part of the four-year forecast period than it projected in December. It notes that the outlook for growth among our trading partners has improved since that December statement. The bank's projection for private consumption is broadly in line with its December MPS forecast. It expects household savings to pick up to 1.2% of total disposable income by 2016 from a negative 0.1% in 2012.
Supplementary question, Dr. Yang.
Thank you, Mr. Speaker. What are the Reserve Bank's latest forecasts for the cost of living over the next few years?
Honourable Stephen Joyce.
Mr. Speaker, on behalf of the Minister of Finance, the Reserve Bank expects consumer and price inflation to remain subdued through the rest of 2013 before gradually rising to the midpoint of its 1 to 3% target band. Headline annual inflation is projected to be 0.9%, 1.4% and 1.8% in the March years to 2013, 14 and 15 respectively. Mr. Speaker, these forecasts of low inflation are good for New Zealand households, particularly those on lower or fixed incomes. In addition, average floating home mortgage interest rates are now around half what they were 5 years ago in 2008. For a family with a $200,000 mortgage, that's saving them around $200 a week.
Supplementary question, Dr. Yang.
Thank you. Now, what alternative economic and monetary policy approaches would put at risk the low inflation and low interest rates currently enjoyed by New Zealanders?
Honourable Stephen Joyce.
Well, Mr. Speaker, on behalf of the Minister of Finance, there are a number of alternative policies that would put substantial benefits of current low inflation and low interest rates at risk, and that would, of course, cost New Zealand households dearly. For example, trying to artificially and substantially devalue the exchange rate, or going soft on inflation. Or, for example, opposing the government's share offer program and instead borrowing billions of dollars more to pay for priority assets like schools and hospitals. Or, for example, just pulling out the photocopier and printing more money. All of those things would send interest rates and inflation through the roof, directly affecting New Zealand households and families. They are, of course, the cornerstones of the Labour Green opposition in the economic agenda.
Supplementary question, Honourable David Parker.
How can the Minister of Finance claim to be a responsible manager of the economy when, as shareholding Minister of Solid Energy, he so clearly mismanaged that at the cost of many, many jobs and many tens, if not hundreds of millions of dollars, just a year after he had the debacle of the loss of hundreds of millions of dollars extra through the mismanagement of the Crown Retail Deposit Scheme, where they didn't even look as to whether there was increased loans on the back of taxpayers following the grant of the guarantee.
Honourable Stephen Joyce.
Mr. Speaker, the member has an interesting take on history, given that it was the former Labour government in 2008 that set up the deposit guarantee scheme, with the support of the opposition at the time because of the difficulties of it. And of course that deposit guarantee scheme has come at some cost to the country, as the member points out, but has actually also helped underpin the New Zealand financial markets, which is one of the key reasons why we have come through the GFC alongside Australia in just about better shape than every other OECD country. And once again we learn, Mr Speaker, that the member has very little understanding of finance whatsoever.
Question number 3, Gareth Hughes.